What is economic data and why is it vital for investors? Economic data comes in many forms and it informs investors and economists on the state of the economy, which has many facets. From jobs data to housing data, there's consumer confidence data and inflation data, and so much more. Altogether, they paint a picture of how the US economy is doing and if we're in an economic expansion or economic contraction. Additionally, they often have an immediate impact on the market. If jobs data misses expectations in a bad way, for example, you might see selling take place. The Federal Reserve's interest rate decisions are also very sensitive to economic data. And since Fed rate cuts or rate hikes also play a role in overall market direction, economic data will also affect stocks from that angle as well. So here we're going to run down the various forms of economic data and what they tell us about the economy. And this is not a comprehensive list of every possible piece of economic data that you could mine for. Economists will likely look at far more data to get a fuller picture of what's happening. But today we're covering the primary data sets that more commonly affect the market. First up, there's jobs data, weekly jobless claims, job openings, and labor turnover survey, also known as JOLTS, and the monthly jobs report from the Bureau of Labor Statistics are three key reports to look out for. There's also private sources of jobs data, including from payroll processing firm ADP. So first, weekly jobless claims. They come out every Thursday from the US Department of Labor. They're important because they are considered a leading indicator of the US labor market and overall economic health. A rise in claims can signal a slowdown, while a drop indicates strengthening job growth, which can impact consumer spending and business investment. Then there's the monthly jobs report from the Bureau of Labor Statistics. The main difference between the two is that the weekly jobless report tracks initial unemployment claims and offers a snapshot of emerging job losses. On the other hand, the monthly jobs report gives you a more comprehensive, albeit delayed picture of the entire labor market, including job growth, the unemployment rate, and wage growth. The weekly report is a quicker, more frequent indicator, and the monthly report is a broader, more detailed analysis based on surveys. And finally, there's the Job Openings and Labor Turnover Survey, also known as JOLTS, which is also from the Bureau of Labor Statistics. This offers both monthly and annual estimates of job openings, hires, firings, and resignations. JOLTS works well in consideration with other labor data like the unemployment rate. It's used to forecast trends in wages, consumer spending, corporate earnings, and more. Together, all three of these are crucial for influencing monetary policy decisions. The Federal Reserve closely monitors jobs data of all kinds because it's a key indicator for the Fed's mandate of achieving maximum employment and stable prices. Strong job growth is often linked to higher wages and inflation, while a weak labor market can lead to lower inflation and is a sign that the economy needs stimulation. Beyond jobs data, there's data focusing on the US consumer. Consumer sentiment, retail sales, and consumer price index, also known as CPI, are all helpful for understanding this. The Consumer Price Index is among the most important pieces of economic data because it's the most widely used measure of inflation. It helps policymakers and investors understand the cost of living and how it changes over time. It provides key data about the price of everything, both currently and in comparison to the prior month and prior year. Ultimately, it's a key factor in guiding Fed policy decisions. And since Fed policy decisions have a very strong impact on the major indexes, CPI is a very important piece of data to pay attention to for investors. Consumer sentiment data is also an important data piece. The University of Michigan's Index of Consumer Sentiment is used as a leading indicator for consumer spending and economic health. Survey takers are asked questions about their financial situation, expectations for the future, and their views on general economic conditions. Then, this creates a score that reflects overall consumer optimism or pessimism. It's yet another data set that helps inform policymakers as they can use the data to understand how their policies might be affecting consumer confidence. Investors and policymakers also pay attention to retail sales data. This gives us a snapshot of the total revenue generated by retailers from selling goods and services to consumers. This includes metrics like sales revenue, inventory levels, customer purchasing patterns, and more. It's used by businesses to understand consumer behavior, measure spending, and measure economic growth. Simply put, retail sales tell us about economic strength. A high rate of retail sales growth indicates a strong economy, while a slowdown can suggest a decline. Next, there's GDP, or Gross Domestic Product, that comes out once a quarter. GDP shows the total value of goods and services produced and the growth rate. This metric also plays an important factor in Fed decisions. It tells us the economic growth rate, indicating whether the economy is expanding, contracting, or stagnating. A common definition of a recession from an economic standpoint is 2 consecutive quarters of negative GDP growth. Next, let's broaden our review of economic data and look at housing-related data. This includes things like pending home sales, U.S. housing starts, existing home sales, new home sales, Case-Shiller Home Price Index, FHFA House Price Index. It's quite a long list, but housing data is also really important as it gives us crucial insights into the health of the economy. Transactions of home sales stand for a very big part of the overall economy. When the housing market slows down, it keeps people from moving for better economic opportunities. And that can very much create a drag on the overall economy, as well as consumers' personal finances. To break it down further, pending home sales are based on signed contracts for existing homes, typically leading actual home sales by 1 to 2 months. An increase in pending home sales suggests more closings are likely in the near future, signaling a healthy or strengthening market. There are also various housing market indexes, such as the FHFA House Price Index, which tracks changes in single-family home values. The Wells Fargo Housing Market Index, meanwhile, is a monthly survey of home builder sentiment. Another index is the Case-Shiller Home Price Index, which measures price changes with separate indices for the national market and 20 major cities. Finally, U.S. housing starts, existing home sales, and new home sales are 3 more important data points to look out for. Housing starts show current levels of construction activity, which not only means greater housing inventory, but also directly creates jobs and stimulates consumer spending. A rising number of housing starts might signal an economic expansion, while a sustained decline can foreshadow a slowdown or a recession. Existing home sales and new home sales are as their titles suggest. Existing home sales just measures the resale of previously owned homes, while new home sales measures the sale of houses built recently. One more important area of economic data to pay attention to is manufacturing data. Manufacturing data like the Institute for Supply Management, or ISM, Manufacturing Index, is a leading economic indicator that provides a snapshot of the health of the U.S. manufacturing sector. The Federal Reserve will use this data to gauge whether we're in an economic expansion or an economic contraction. It plays a key part in informing interest rate decisions and other policy decisions. A strong reading can signal a need for tighter policy, while a weak one may prompt stimulus. An index of 50 reflects no change in recent manufacturing activity. Above 50 means expansion of activity within the nation's factories, while under 50 points to a contraction. The index essentially tracks key indicators like production, employment, supplier deliveries, new orders, and inventories. While this list is not comprehensive by any means, it can serve as a brief checklist for what to pay attention to on a weekly, monthly, and quarterly basis. Economic data can absolutely affect overall market trends. As investors, we need to be aware of when data is due and how it might affect the stocks in our portfolio. Also, be sure to be aware of how the various data might affect the Fed's interest rate decisions.